A fever spike is rattling the healthiest part of the patient. Semiconductors are running hot, with a cardiac event brewing in the AI trade. The question isn't whether tech can hold, but how long before this infection spreads to the broader portfolio. Every index dropped today, yet something deeper is happening beneath the surface. The semiconductor engine is flatlining. SMH shed 5.04%, as SK Hynix results failed to impress investors who had priced in explosive AI demand growth. This wasn't a mild cough. It's a full-blown fever of 1,768 points lost on the Nasdaq, with Speculators IRK and SPHB also coughing up blood at 2.82% and 3.4%. Capital is rotating out of high-growth exposure as valuation compression accelerates into earnings season. The 10Y Treasury held steady at 4.62%, but TLT dropped 1.45%. A signal that even safe haven bonds aren't immune to this pressure. Yields remain elevated, and the credit spread environment is tightening as institutions pull back from duration exposure. Our metrics confirm leverage in the tech sector amplified losses today, with margin calls likely contributing to forced selling cascades. Fear products are running hot. UVXY surged 10.12%, while VIXY gained 6.83%. Confirming elevated uncertainty without full-blown panic. The VIX sitting at 20.23 is the highest in 6 months, yet still below true crisis levels. This suggests a controlled retreat rather than system-wide collapse. The portfolio knows how to cough up blood but hasn't reached cardiac arrest territory. Earnings are exposing cracks in the growth narrative. Meta missed Q2 guidance, and Tesla faces $1 trillion status pressure as AI monetization timelines shift. The Russell 2000 dropped proportionally more than large caps, meaning smaller companies with thinner margins feel the heat faster. Our data indicates corporate earnings season is transitioning from pricing power questions to revenue execution concerns. Gold gained a modest 0.23%, while bond products rose 0.71%. Showing defensive positioning is working, but not aggressively so. The portfolio is hedging rather than fleeing. XLP consumer staples only moved plus 0.22% as investors balance protection against overexposure. This measured response suggests institutions are managing the bleed, not bailing out entirely. The hero portfolio faces a multi-front attack from sector rotation and earnings disappointment, but the villain hasn't overwhelmed defenses yet. SMH's 5% drop is the leading indicator. If the semiconductor engine stabilizes by next week, we see limited downside extension. The fear spike is contained enough that panic selling hasn't taken root. This is a controlled fever, not sepsis. The Canary dashboard shows elevated but manageable stress with semiconductors as the infection source and earnings as the vector. Protect growth exposure while monitoring if the fever spreads beyond tech. Stay sharp through Meta's earnings tomorrow as confirmation of whether this rotation continues or reverses. The data is singing. A controlled cooldown, not a cardiac event.